Welcome back to the deep dive. Today we're going to get into some pretty interesting stuff. We're talking leverage,
Lever.
specifically in the U.S. stock market. And, we're diving into a subscriber-only podcast that really tries to unpack how to use leverage
Okay.
for both, those long-term gains, but also for some of those, maybe shorter-term wins.
Right.
And I guess I think of it as like we all want financial security.
Absolutely.
Like maybe even, thinking about retiring early or that dream trip you've always wanted to take or whatever it is.
You're sure.
I think, a lot of us are really wondering how we can amplify those returns,
Mm.
right? How can we use leverage?
Yeah. I mean, the thing that was so interesting about this source material was it sort of frames the stock market not as just a place to put your money and hope for the best,
Right.
but as a system with actual levers you can pull.
Mm.
And leverage is a pretty powerful lever.
For sure. But like everyone, I think I'm a little bit, wary of risk.
Yeah.
So I'm curious how this source balances, the potential rewards with the risks that come with leverage.
Right. It's really understanding your own risk tolerance and what you're aiming for, because there's no one size fits all approach.
Right, right. So let's get into the details. So the source starts talking about, this idea of volatility and allocation.
Okay.
And they use this example. Imagine you have $100 to invest.
Okay.
You could put all $100 into an asset that fluctuates by 1% every day.
Okay.
Or you could split that $100, put $50 into an asset that swings by 2% daily, and keep the other $50 in cash.
Right.
Now, I got to admit, my gut reaction is, oh, that 1% fluctuation, that seems safer to me.
Yeah.
But, listening to this, it made me think twice about that.
I mean, that's exactly the point they're making, right? It's not always about trying to just avoid volatility altogether.
Right.
It's understanding how to allocate in a way that strategically can actually lead to lower volatility overall, even while including something that moves around a lot more. So even though that one asset is going up or down 2% in this example, daily, your portfolio, as a whole, ends up having the same level of volatility as if you put it all into that thing that just moves 1%.
Hold on. Are you saying I could get, similar volatility with the chance of higher returns just by diversifying a little bit?
Yeah, that's essentially what they're suggesting.
Right.
And the sort of secret ingredient here is that cash buffer,
Hmm.
right? It acts as a shock absorber when the market takes a dip. So if that 2% asset drops, you've got this cash portion that's helping to cushion the blow.
Oh, so that cash reserve isn't just peace of mind. It's like an actual strategic tool for when the market dips and there are buying opportunities.
Exactly.
Okay.
You have the flexibility to buy when other people are panicking.
Right, right. Well, speaking of market dips, that's another thing that the source gets into. And, I know they're inevitable, but, the source mentions some data about how frequent 5% and 10% dips actually are. And I remember these numbers being really surprising.
Yeah, it is kind of surprising. So since 1980, the U.S. market has seen at least a 5% dip, on average about 5 times per year.
5 times a year.
Mm.
That's way more often than I would have guessed.
Yeah, I know.
That makes me feel like those dips aren't really that unusual at all.
No, not really.
Okay. So what about the larger drops, 10% corrections?
Right. So if you look at the S&P 500 data going back to 1950, you see that a 10% correction on average happens about once a year,
Wow.
consistently,
It's just it is part of the game.
Yeah.
Well, that's both fascinating and unsettling,
Yeah.
It really makes me think that you need a solid strategy,
For sure.
especially one to help navigate those downturns, because they are going to happen.
Yeah. And that's where this long-term investing thing comes in. I'm sure you've heard people talking about the lost decade in U.S. markets.
Yeah.
I mean, that fear is out there. Right.
But this source seems to have a different perspective on that.
Yeah, they do, for sure.
And it comes down to two things. One, the U.S. has some pretty big competitive advantages in the global market. Think about innovation, the financial systems, skilled workforce, all those things that contribute to long-term growth.
So even if there are, short-term fluctuations, the long-term outlook still seems pretty strong.
Right.
Okay.
And the second point they make is about the incentives of the major players.
Mm.
The government, the tech giants, Wall Street, they all have a vested interest in keeping this market stable.
I mean, they don't want to see the market crash.
No, they don't.
Right. So that makes sense. But what about the actual historical data? Like, does that back this up?
Yeah, that's the encouraging part. If you look at the history of the U.S. stock market,
Right.
it's had this remarkable ability to rebound. Like, it always seems to reach new highs eventually.
Okay, that is reassuring,
Yeah.
especially given all this talk about market volatility.
Right. Yeah. And potential dips. It makes me think maybe we shouldn't get so caught up in the short-term stuff
Yeah.
and focus more on that bigger picture.
Well, that leads us to this concept the source highlights called extreme value bias. Have you
Okay.
ever heard of that?
Extreme value bias. I don't think so.
So it's a cognitive bias that can really trip up even the most seasoned investors.
Yeah.
And essentially, it's this tendency to fixate on rare extreme events, those black swan events,
Okay.
things that make headlines, make us feel uneasy.
So, like, what if the market crashes tomorrow?
Exactly.
Right.
But we tend to overestimate the likelihood of those things happening,
Okay.
and then we end up making fear-based decisions.
So it's like, planning your life around winning the lottery.
Yeah, exactly.
Okay.
The source is saying we need to shift our focus away from those outlier events,
Okay.
ground ourselves in the data.
So instead of like worst case scenarios, just focus on average levels, normal market distributions, look at the long-term trends.
Yeah. Okay.
Making decisions based on like reason and probability, not the what ifs.
Okay. Well, this has been incredibly helpful in understanding the broader market, but I'm curious about the specific strategies this source suggests
Okay.
when it comes to actually using leverage. Do they get into that?
Yeah, they do. They offer two distinct approaches
Okay.
based on risk appetite and investment style. So one is more conservative, the other is a bit more aggressive.
Okay, so let's start with the conservative approach then. What's the game plan?
All right. So for folks who want to minimize risk, but still participate in that market growth,
Right.
they suggest allocating 70% of the investments into a leveraged index fund, something like QLD.
Okay, QLD, yeah.
Yeah.
So that's the 2x leveraged ETF that tracks the NASDAQ 100, right?
Right.
So if the NASDAQ goes up 1%, QLD goes up 2%.
Yeah.
But then wouldn't that mean if the NASDAQ goes down 1%, QLD goes down 2%?
Yeah, exactly.
Oh.
That's leverage.
I'm trying to wrap my head around how that's conservative. Okay, well, the remaining 30% would be in a high-yield USD deposit with semi-annual terms.
Okay, so you're still participating in the market's growth
Right,
with that QLD, but you have a safety net
right.
with that cash reserve.
Yeah.
So that cash helps to kind of like balance out the volatility
Yeah,
of that leveraged ETF.
right.
Okay, but what about the semi-annual terms? What does that mean?
It just means that the interest on that deposit is paid out twice a year, which can, provide a steady stream of income to kind of offset potential losses.
Okay, so it's really about finding that balance, that growth potential,
Exactly.
and mitigating the risk.
Yeah.
Okay, I like that. But what about those market dips we talked about? How do you handle those?
Well, that's when that cash reserve comes in handy.
Okay.
They actually recommend using that cash to buy more of the leveraged ETF when the market dips. There are specific entry points they give based on how much the SPY drops.
So like, the SPY tracking the S&P 500.
Right.
Okay.
So, for example, you might buy more after a 10% drop.
Then, if it falls further, you buy more.
So you're using the market dips to your advantage,
Exactly.
like getting a discount on your investment.
Yeah, think of it that way.
That's cool. But what about, those who are a bit more comfortable with risk?
Right.
Maybe looking for more aggressive strategies. Do they address that as well?
They do.
Uh,
And it's a completely different approach.
Ooh, now you've got me intrigued. Tell me about this aggressive strategy.
Okay, so they recognize that a lot of investors, especially those who like to stay active, they feel this like pull towards short-term trading, trying to time those market swings, pick winning stocks.
Right. I mean, it's tempting when you see a stock taking off.
Yeah.
But I know that going all in on those short-term bets can backfire.
Oh, absolutely. So instead of keeping that 30% we talked about, like in a safe, low-yield environment, they suggest putting it towards those shorter-term trades,
Okay.
which some might call speculation.
Right. But, and this is key, they say, keep that 70% anchored in that long-term leveraged index ETF.
Okay.
So it's like the solid base of your portfolio.
Right?
And then that 30% allows you to kind of scratch that trading itch.
Okay, so you kind of get the best of both worlds.
Yeah.
You get that long-term growth and then a little bit of rent
Right.
on the side with the speculation. But is it just about satisfying that urge to trade, or can you actually make like significant returns from that 30%?
You can. This approach is particularly powerful for those who have, like, an edge.
An edge.
Yeah, like, folks who are deeply embedded in a particular industry, maybe they have access to unique data or they can spot trends before they hit the mainstream.
It's like, people in finance or tech,
Yeah.
investment banking. Not like insider information, of course.
Right, right.
But just a deeper understanding of certain sectors that can give them an advantage.
Exactly. And they talk specifically about those big players within the S&P 500, trying to capture what's called alpha.
Alpha.
Oh.
Okay, I've heard that term, but to be honest, I don't know if I really get it.
Okay, so imagine the overall stock market goes up 10% in a year. If your investments go up 10%, you've matched the market, right?
Right.
But if your investments go up 15%, that extra 5%, that's your alpha.
Oh, good.
That's outperformance, and that's what a lot of short-term traders are after.
Okay, I get it. So this aggressive strategy is really for those who want to, like, actively manage a portion of their portfolio.
Right.
And aim for those higher returns. But, let's be realistic, there are always risks involved.
Sure.
What are some of the things to watch out for with this approach?
Well, they emphasize setting a clear time horizon.
Okay.
So they suggest thinking of short term as like a rolling 12-month period.
So you're constantly evaluating those trades.
Exactly. You don't want to get like emotionally attached to losing trades and let them drag on.
I've done that. It's hard to, like, admit defeat
Yeah.
and cut your losses, but, holding onto a sinking ship rarely works out.
No, it doesn't. It's better to move on, find new opportunities. Another point they make is about stock selection.
Okay.
They recommend sticking to large cap stocks.
Okay.
So companies with a proven track record.
Right. So less about chasing those penny stocks or, risky startups.
Yeah, exactly. Minimize that volatility within that 30%.
Okay.
Now, when it comes to actually choosing those large cap stocks, they get really specific.
Okay, this is where I'm all ears. What's the secret?
They emphasize 4 key factors. And it's interesting because the order actually matters.
Oh, okay, lay it on me.
Okay, number 1, and this is crucial, is capital flows.
Capital flows.
Yeah, liquidity.
Okay.
Like, is there significant trading volume behind the stock? Is money flowing in? Because without that, prices just won't move, even if everything else looks good.
So even if a company has a great story, good fundamentals, but if nobody's buying or selling, it's not going anywhere.
Exactly. It takes money to make money.
Okay, that makes sense.
Next comes the narrative or market sentiment. Like, what's the story surrounding the stock? Is there buzz? Is there hype?
Okay.
Because perception, even if it's not based on reality, can drive those short-term price movements.
So understanding the psychology of the market, like
Yeah.
what's driving those emotional decisions?
Exactly. Now, the third factor is where things get more grounded.
Okay.
Fundamentals. This is about looking at the underlying factors that determine a company's long-term value.
Okay.
Things like the economic cycle,
Right.
industry trends, company's profitability.
Ah, so logic and reason come into play here. But you're saying in the short term, those emotions can outweigh the logic.
Totally. It's like a tug of war,
Hmm.
logic versus emotion. And in the short term, emotion usually wins.
Right.
But those fundamentals eventually will play a role in the long term.
Okay. So what's the last piece then? The fourth factor.
Technical analysis.
Ah, yes.
Studying chart patterns.
Yeah.
Trading volume. Other indicators to try to predict those price movements.
Looking for clues.
Yeah, patterns, signals that can give you an edge.
So this aggressive strategy is all about combining like a deep understanding of the market with a bit of intuition
Yeah,
and a sharp eye for those signals.
right.
But let's shift gears for a moment. The source also mentioned using leveraged ETFs for individual stocks, specifically AMDL as an example. That seems like it would amplify risk even more.
It comes down to capital efficiency.
Capital efficiency.
Yeah. Let's say you're bullish on a company like AMD,
Okay.
which AMDL tracks. Instead of tying up all your capital buying AMD stock outright, you could invest in AMDL,
Okay.
which offers 3x the exposure to AMD's price movements.
Okay.
You achieve similar returns, but with less capital up front, which frees up your cash for other opportunities.
So you could see the same gains with a smaller investment.
Potentially. But of course, you have to manage the added risk of that 3x leverage.
Right.
That's where careful position sizing comes in.
Okay.
You wouldn't put your whole portfolio into something like AMDL. You'd use it strategically as part of a diversified portfolio
Okay.
with other less volatile assets.
Okay, I see. It all kind of fits together.
Yeah.
You've got the long-term leveraged index fund for steady growth.
Right.
Then a portion for those short-term trades, maybe using leveraged ETFs
Right.
to maximize that capital efficiency.
Right.
But how do you choose which leveraged ETFs to use for those short-term plays?
They suggest sticking with those popular companies that already have leveraged ETFs available.
Ah.
They typically have higher trading volume,
Okay.
more liquidity, which is important for short-term trading. Plus, focusing on companies you understand, you believe in, can give you an extra edge.
So instead of like trying to pick those obscure companies or bet on the next big thing, it's more about like leveraging your existing knowledge
Yeah,
and finding those opportunities within those well-established companies.
right, exactly. Finding that sweet spot between familiarity and potential for growth.
Okay. All this talk about leveraged ETFs is making me think about the downsides.
Hmm.
It seems like there are some risks we haven't touched on yet. It seems like there's some risks we haven't touched on yet.
Yeah, I mean, leverage is a double-edged sword, right?
Right.
It can amplify those gains, but it can also magnify your losses. And it's really important to remember that leveraged ETFs are inherently more volatile
Okay.
than their non-leveraged counterparts. So if the market moves against you, those losses can pile up really quickly, and you could end up losing more than you initially invested.
So this is definitely not like a set it and forget it kind of thing.
Right.
You got to be on top of it.
You need to actively monitor your positions, be ready to adjust your strategy. It requires a higher risk tolerance, for sure, and a clear understanding of how leverage works. You need to be okay with the fact that your investments could fluctuate a lot, at least in the short term.
Right.
It's also crucial to have a well-defined exit strategy.
Okay.
Knowing when to cut your losses is just as important as knowing when to take profits.
So I'm hearing a lot about risk management,
Yeah.
which makes sense. But beyond like the practical stuff, are there any mental traps or biases that we should be aware of when it comes to leverage?
Yeah, it's interesting. This source actually dedicates a whole section to cognitive biases
Okay.
that can trip up investors. We talked about extreme value bias earlier,
Right.
but there are others.
Okay. So beyond fixating on those like rare catastrophic events, what else should we watch out for?
Well, there's rare event bias, which is closely related to extreme value bias.
Okay.
It's basically where we overestimate the probability of unlikely events happening.
Right.
And then there's availability bias,
Availability bias.
where recent or highly publicized events disproportionately influence our decisions. So think about like if there's been a recent market crash, it might make you overly cautious.
Even if the market has already recovered.
Right, because
yeah.
our brains tend to remember those vivid memories, even if they're not really representative of the big picture.
Right. It's like, well, it just happened, so it could happen again.
Exactly. Any other biases come to mind?
Yeah. Are there any others that they mentioned?
Let's see. There's catastrophic thinking bias, where we tend to focus on those worst-case scenarios. And then there's tail risk, which refers to the risk of those extreme outlier events actually happening.
So it seems like a lot of this comes down to like fear and uncertainty.
Yeah.
It sounds like the key is to, stay informed, keep a level head, and don't let those emotions get the best of us.
Yeah, absolutely. I mean, leverage is a powerful tool, but it requires a disciplined and informed approach. It's about understanding both the potential upside and the risks, and recognizing those biases that can really cloud our judgment.
Well, as we wrap up this deep dive into leverage,
Yeah.
what's the one thing you hope our listener takes away?
I think the biggest thing is there's no one right way to invest.
Right.
Leverage can be a great way to potentially boost your returns, but it's not for everyone. You have to consider your risk tolerance, your goals, your timeline before jumping in. And remember, knowledge is your most valuable asset. The more you understand about leverage, the better you'll be able to use it effectively and responsibly.
That's great advice. And speaking of knowledge, we always encourage you to keep exploring.
Yeah,
Dig deeper into leverage, experiment with different strategies,
for sure.
see what works best for you.
Yeah, the most successful investors are those who are constantly learning, adapting, refining their approaches. They're not afraid to try new things, but they do it with a clear understanding of the risks.
So stay curious, stay informed, and keep diving deep. Until next time, happy investing.